Canada's housing market has gained global attention for having some of the most expensive real estate relative to household income. And while home prices have declined nationally by approximately 17%, many regions such as Montreal, Calgary, and even Winnipeg have seen little to no change. The steepest declines in property values across the country are occurring in the country's two largest metropolitan areas, Vancouver and Toronto, which is primarily due to weakened demand caused by rising mortgage rates over the past few years, in combination with price points that remain extremely high, which have increased borrowing costs and reduced overall purchasing power for many households. And despite a significant slowdown in the number of transactions over the past 2 years due to this reduced purchasing power, one major concern remains for the millions of Canadians who bought property during the era of record low interest rates. With their mortgages set to renew in 2025 and 2026, are they financially prepared to absorb the higher monthly financing costs? Well, let's talk about that. Back in January of 2020, the average house across Canada cost a mere $506,000, which, considering the average 5-year fixed discounted mortgage rate of 2.49% at the time and a 20% down payment of $100,000 and some change, well, this meant that the average monthly mortgage payment would have been around $1,813 if amortized over the standard 25 years. Fast forward to the height of Canada's real estate frenzy in February of 2022, and the narrative changes quite a bit, as the average sold price climbed to a staggering $816,720, which was at a time when 5-year fixed mortgage rates had creeped back up from their rock bottom levels to 2.34%. So if you're following here, in a matter of only 24 months, average sold prices climbed by over $300,000, while financing costs stayed nearly flat. The math simply doesn't math for the average household, where for the most part, household incomes have stayed relatively unchanged. Regardless though, this meant that on the $816,000 home, monthly mortgage payments would have been around $2,878, which again, for many Canadian households is completely out of reach, and therefore decreased demand has now led to prices coming off quite significantly from their all-time highs, specifically in the Greater Toronto and Greater Vancouver areas, although truth be told, they are still quite a bit higher than they were only 5 years prior. Now, if you ask your realtor if this is simply the new normal, the answer will almost certainly be that yes, it is, and that you should buy before prices increase once again. After all, now is always the best time to buy, right? Well, with immigration levels being scaled back significantly, potentially therefore reducing demand, alongside municipal efforts to boost housing supply, economic uncertainty driven by possible UF tariffs on the horizon, and mounting concerns over wage stagnation and overall affordability, many are left wondering, is now actually the right time to buy, or are further price corrections on the horizon? Let's talk interest rates. So although many factors such as job and population growth, average wages, and just overall economic stability for an area contribute to real estate price fluctuations in any given part of the country, one of the most significant levers that the government holds over the housing market is the interest rate that it sets forth. Well, technically the Bank of Canada. Now, although these two factors don't directly influence each other, lower interest rates typically encourage buyers to enter the market by increasing that purchasing power. And with interest rates steadily declining by a total of 2% throughout 2024, this is expected to impact the housing market favorably, while also providing some financial relief for the homeowners that are facing renewals in 2025 and 2026. And overall, it remains very uncertain whether interest rates will continue to decline at this point, as the Bank of Canada's latest announcement was notably vague, emphasizing the broader economic uncertainty unfolding in the country, particularly with potential impacts of US trade tariffs on Canada.
The potential for a trade conflict triggered by new US tariffs on Canadian exports is a major uncertainty. This could be very disruptive to the Canadian economy and is clouding the economic outlook.
Now, I'm of the mindset that if the US does move forward with trade tariffs and Canada ends up retaliating, this will have a material impact on our GDP growth, leading it to struggle even more than it is already, and will throw us into a true recession, at which point the Bank of Canada may very well drop rates even further. Although that is total speculation for the time being, no one ultimately knows how this will play out. But even if we consider that tariffs were off the table for now, I think it's quite probable that we would continue seeing at least one, potentially even two more rate cuts over the next 12 months. Now, as I said earlier, the most popular Canadian mortgage term is 5 years. Here in Canada, we don't have 30-year mortgages. Generally, they're going to renew every 5 years, meaning rates that were secured at these rock bottom levels in 2021 and 2020 will now be up for renewal in 2025 and 2026. In fact, based on data from RBC, BMO, Scotiabank, and CIBC, 24% of Canadian mortgages are up for renewal throughout 2025, 35% are up for renewal in 2026, and 23% are up for renewal in 2027. Meaning over the course of these next 3 years alone, 80% of Canadian mortgages will have cycled through, and almost the entirety having moved away from pandemic era interest rates. So it's safe to consider here that for anyone who purchased a property in 2020 or 2021 and ended up securing a rock bottom rate below 2% as they were at the time, is set to experience a relatively significant increase in their monthly mortgage payment, and the portion of that payment going towards equity will come down, even though rates are a lot lower right now than they were only a year ago. Now, the initial concern throughout 2023 and 2024 was that when these mortgages eventually come to term and were set to renew, there would be widespread financial pain felt throughout the country, and that with higher interest rates, wide-scale defaulting could very well occur, resulting in a flood of opportunities on the market, driving up supply and bringing down values. Well, for now, mortgage delinquencies have actually stayed very minimal throughout the country, increasing to only 0.2% as of Q3 2024, which for the time being, as I'm recording this video, is the latest data that we have at our disposal. And for the record, this accounts for around 4,000 mortgages out of the total 2.04 million mortgages in Canada. Now, of course, one could argue that this data is somewhat inconsequential for now, as again, 80% of mortgages will renew in 25 through to 2027. But let's consider that the 15% of mortgages that have already renewed in 2024 at much higher interest rates than what would be available in 25 and 26 have actually not resulted in highly increased defaults. So even though rates are still well above where they were at in 2021 and 2022, I don't actually think we'll be seeing a significant uptick in delinquencies, which would be anywhere near enough to have a material impact on the housing market. And combining this with dropping housing starts, our supply issue also still hasn't been solved. As of December 2024, housing starts in Canada have actually fallen 13% compared to 1 month prior in November, which was attributed to a decrease in the number of new homes being started in both single-family and multi-family homes. And unfortunately, fewer starts right now will actually mean even less supply in a year or two down the line. Additionally, the way it generally works is that the number of housing starts in general are all grouped together, from multifamily properties to single-family, semi-detached, row homes, and condos. So when considering the amount of homes that are being built in contrast to total housing starts for apartments with the purpose of housing renters exclusively, many of which are newcomers to the country, well, the picture gets even more bleak. Out of the 231,000 seasonally adjusted housing starts across Canada as of December of 2024, well, a massive percentage of them are apartment-style properties that tend to rent out units rather than sell them, thus not increasing housing supply on the market. So while building more rental units is certainly a contributing factor to increasing the supply to house people period, well, it isn't a huge contributing factor to bringing down the value of single family, row homes, or even condos in some markets. Toronto is really the only huge exception here, where the amount of condos that flooded the market over the past couple of years increased supply dramatically, and the demand simply isn't there right now, thus bringing down the value of condos in the GTA quite a bit. But that's pretty much a one given market situation. And so yes, while immigration targets have now been set lower by the government, well, in reality, this will impact rent values a lot more than it will impact property prices, as we discussed in my last video from a few days ago. And overall, despite prices having come down across the country, we're still seeing prices that are generally considered to be highly unaffordable for the average Canadian, with the only real solution to a massive price correction anytime soon being a wide-scale recession, which is its own set of challenges for everyday citizens. That isn't really something we want to see. Let me know down in the comments what your thoughts are on the current state of the Canadian housing market. I would love to know. And by the way, if you would like to support the channel while also getting some free money for opening up an investment account, make sure to check out the links down below in the pinned comment and video description to open up a TFSA RRSP or just a regular investment account with Moomoo. And you can get up to a couple $1,000s in promotional bonuses for opening up and funding an account. Thanks a lot for watching, and I'll see you in the next one.